Not that silver goes down from 95 to 85. The gold goes from 4,800 to 4,500 in this big correction. I expect it. I expect a correction. Listen to what David Jensen says. He's the expert on the LBMA. He will tell you that there's 700 or 800 million ounces of silver in the LBMA, of which the majority belongs to the ETFs like SLV, storage programs like Bullion Vault that store it there. That's not for sale. They say there's a 140 million ounce float, which he disputes and says, I don't know if that's really free float. We see gold at $39,000. If we use M2 liabilities divided by gold reserves, $184,000. That's not James Rickards or me or Mike Maloney. Right? That's Van Hook. Luongo's theory is that he believes it was the European aristocrats, and the way you get them is to blow up the positions on the LBMA. Because the Economic Times says the 5 U.S. banks that were short have flip-flopped and gone long. JP Morgan covered a 200 million ounce short. These people that are standing for delivery for 100 million ounces in 40 days, do you think they're using margin? These are central banks, commercial banks, Tesla, Samsung, you name it.
Okay, let's say we hit those big round numbers. $100 an ounce silver, $5,000 an ounce gold. In your mind, what should folks think about doing at those milestones? Is that, my God, we got here so much faster than we thought, sell, consider yourself lucky? Or are you seeing such momentum still in the system? You think this whole rising tide is going to continue going higher from here?
I think the first thing you have to understand, Adam, is that gold and silver really forever have not been allowed to reach real price discovery.
True price discovery.
Yeah, and where is it really? I think if you want to know the real story, watch the delivery behavior. And, a standard COMEX contract is 5,000 ounces, right? And what we saw in December was the largest delivery in the history of the COMEX market for the month of December, like 68 million ounces. A mint box of Silver Eagles weighs 500 pounds, or 500 ounces weigh 42 pounds. Who just bought, actually it was 64,730,000 ounces were delivered in December, the largest ever in the history of the COMEX.
The real story here isn't price targets, it's who quietly took delivery while everyone else watched charts. Andy Schectman points out that price headlines distract from the mechanics that matter most: physical delivery, not futures hype. December's 64 million ounce COMEX delivery wasn't retail panic buying. It was institutional scale accumulation, the kind that historically precedes regime shifts, like we saw before the 2008 liquidity break. When markets suppress price discovery long enough, pressure builds invisibly until it snaps. For investors, this reframes $100 silver not as an endgame, but as evidence of unfinished repricing beneath the surface. And next, Andy Schectman explains why January's numbers may matter even more than December's shock.
And January, which is not a scheduled delivery month, we've already seen close to 40 million ounces of silver delivered, maybe more. Last I checked, 110 million ounces in the last 40 days. And there's not a word about it. Or 5 or 6 million ounces of gold along the way with that. Not a word about it. And that's what we have been seeing for the last 15 months, every single month. Not a word about it. I scream about it. The mainstream media, these jokers who actually think that they are doing right by the public, don't speak about the fact that gold and silver have eviscerated the S&P in the midst of the greatest tech boom in history. And even more relevant than the performance, which has been amazing, is the deliveries. Now, the deliveries to me say everything. The deliveries are being done by the most well-informed and well-funded traders on the planet, period. Now, I've been for 5 years saying it's been the central banks, and they started the ball rolling. That was crazy enough. But what you see right now is the most well-informed traders here in the United States. And that's a whole different thing. And delivery at that level should not be ignored. In fact, to me, it's all you need to see.
Here's the disconnect. Wall Street avoids. Unscheduled deliveries don't happen by accident. Andy Schectman highlights that 110 million ounces moving in 40 days dwarfs typical COMEX activity, especially during months when delivery isn't expected. That kind of behavior mirrors pre-crisis positioning we saw ahead of 2020 liquidity freezes, when insiders acted first and headlines followed months later. While media fixates on tech multiples and AI narratives, capital is quietly rotating into assets that hedge systemic risk. For investors, this divergence signals institutional risk management, not speculation, unfolding in real time. And what Andy Schectman points out next reframes why performance may be the least important metric right now.
Now, in a market like we see right now, you know, I promised you, and I've said it before, I said it last time we were together, I will tell you when I think it's time to bail.
Right.
But this is not even close to it. The dips that we see right now, in my mind, are a gift because they are driven by positioning and leverage, and not by a sudden surplus of metal, period. And I think that the risk is waking up, not that not that silver goes down from 95 to 85, or the gold goes from 4,800 to 4,500 in this big correction. I expect it. I expect a correction, and one is corrections are normal, but the risk to me is not being able to get what you want at any reasonable premium, period. So yes, short-term caution is appropriate. Long-term conviction is also massively appropriate, in my opinion. They should both be able to live together. And look, when you see the Shanghai market in silver pricing above $8, $9, $10 above Western spot and futures, it's basically the market screaming that the metal is worth far more than where it's being financially priced. And when you see the lease rates going way up, the widening spread is a signal of tightness in the market.
Corrections grab attention, but access risk is what quietly punishes portfolios. Andy Schectman makes a critical distinction here. Price volatility driven by leverage is noise, while physical scarcity is structural. Historically, during tightness cycles like 2006 to 2007 commodities or 2021 energy, price dips coincided with worsening availability, not relief. Shanghai premiums $8 to $10 above Western spot reflect real-world demand overwhelming paper pricing, a classic sign of misaligned markets. For long-term investors, the risk isn't drawdowns, it's being priced out when liquidity vanishes. And Andy Schectman's next point explains why these premiums are flashing louder than charts ever could.
It's not a rounding error that we continue to see. The raising of margins. That's what in 2011, they jacked the margin rates up so high, it flushed everyone out. This time, they raised margin by 30% the day after Christmas, from 21,000 to 27,000 in your margin account to control one 5,000 ounce silver contract. Shook all the people out that were using margin and needed to sell to cover these margin requests or demands. And if you didn't pay it up by the end of the day, then you get a margin call. Well, what happened? Normally in 2011, and normally that kneecaps the market. These people that are standing for delivery for 100 million ounces in 40 days, do you think they're using margin? No, they're not. This is the highest level of high. These are central banks, commercial banks, Tesla, Samsung, you name it. Tesla and Samsung would be poor compared to the people that are standing for delivery at this level. These are sovereign nations. This is the US government. This is repricing in an asset that has never been allowed to find real price discovery. And I do believe that. And I think when you use technical analysis in a rigged market, it's invalid. Mm-hmm. And I think what you see here is a microcosm of what I expect to see. You know, part of the way that these banks have been able to save themselves is through rhetoric.
Margin hikes don't scare strong hands. They're designed to shake out weak ones. Andy Schectman draws a sharp contrast between 2011's retail-driven market and today's delivery-led accumulation by entities that don't borrow to buy. When margin requirements jump 30% overnight and delivery volumes stay elevated, it signals buyers operating outside speculative pressure, sovereign scale capital, not traders. Historically, when margin hikes fail to suppress price, it precedes structural repricing, not tops. For investors relying solely on technical indicators, this is where models break. And Andy Schectman's next insight exposes why rhetoric may be the last tool left for suppression.
You never see the media talking about it, right? Never. And that's always bothered me, but it is what it is. But the rhetoric is, very important. So TD Bank, right? You know, there's this rumor that Tom Luongo has that, and I think he's someone worth interviewing. He's a very smart man, and his theory is that Trump said it today in Davos. He said, you know, the election in 2020 was rigged, and people are going to get prosecuted. He said, I probably shouldn't have said that. That's breaking news, but it's coming out.
Yeah, I heard that.
And so Luongo's theory is that he believes it was the European aristocrats, and the way you get them is to blow up the positions on the LBMA. In essence, that's part of what he thinks, because the Economic Times says the 5 U.S. banks that were short have flip-flopped and gone long. Now, that's what the Economic Times says. JP Morgan covered a 200 million ounce short position, they say, and have been buying millions and millions of ounces of physical. And that the 5 banks of the 8 Western banks that were short all of these years collusively going back and forth to hold the price of gold and silver down, the U.S. banks are now long, exposing the short banks. So TD Bank, I'm going to read to you what TD Bank did in Canada.
The real story here isn't politics. It's why banks quietly change sides before the headlines do. As Andy Schectman has pointed out, when US banks allegedly flip from short to long, it signals positioning ahead of a structural break, not a news cycle. A reported 200 million ounce short allegedly covered isn't trivial. Global annual silver mine supply is roughly 820 million ounces, which frames the scale of this shift. If Western banks are now long, while European institutions remain short, the power dynamic flips fast. This matters because price suppression only works when the largest players agree, and that coordination appears to be breaking. Investors should watch positioning, not speeches. What he connects next explains why this tension may be reaching a forced resolution.
They came out 2 weeks ago and said, we enter short spot silver anticipating a dramatic reversal in prices as silver's devilish blow-off top comes to completion. TD Securities entered a short position in silver futures in early January 2026, betting the price would fall towards $40 an ounce. They placed a stop loss around $92 an ounce to limit losses as the price went the other way. And guess what? They just got stopped out on Friday. They're $92 an ounce. They were hoping that they could engineer this, and it's not working anymore. And I think you see a repricing of gold and silver that has even yet to even begin to find equilibrium with where it should be. So yeah, I'm not a perma bull, but I do believe that this is just beginning. I do believe that.
Okay, so many questions that came out of that. Let me bang through a couple things. First off, you talked about the premium on the Shanghai exchange, you know, somewhere around $10 an ounce. Can you explain to folks exactly like why the imbalance there? How come there's not an arbitrage that closes that?
That's what they're trying. They keep keeping it there to arbitrage it instead of closing it. In other words, the traders who have the ability to buy paper in the West and deliver physical in China are doing so.
This is what happens when conviction collides with physical reality. Andy Schectman has warned that paper-driven shorts fail when price discovery escapes futures markets, and TD's stop out near $92 is a textbook example. A bet targeting $40 silver with a stop over $90 shows how disconnected models were from real demand, especially with Shanghai trading roughly $10 above Western prices. That persistent premium isn't a glitch. It's proof that arbitrage exists because physical supply is being pulled east. When paper shorts can't force price down anymore, repricing accelerates. Portfolio risk rises fast when leverage meets scarcity. His next point explains why this imbalance isn't closing. It's widening.
You give them a million ounces, you just made 8, 10, 12 million dollars. Give them 20 million ounces, you made what? A lot. You make $200 million, easy peasy.
Let me make sure I understand then. You buy paper contracts in the West, you stand for delivery, you get your silver at whatever the current spot price is in the West, let's say $93. You then take that physical and you sell it to a Chinese buyer in China for $10 more.
Yes, I mean, what people don't realize is that there is a COMEX contract that delivers in Hong Kong, and it's into a COMEX facility. So you can deliver COMEX contracts, what's called exchange for physical, where you actually deliver the physical in Hong Kong. It's then picked up by a truck and driven to the Shanghai Metals Exchange.
Wow, so
Pretty
you don't
much.
even have shipping costs from the West over there. You just pick it up in Hong Kong.
Yes, or sometimes they have to ship it there. But the bottom line is that there is a COMEX contract that does deliver in Hong Kong, part of the COMEX ecosystem. Would have been probably a Brinks facility. I'm not sure which one it is, but yes, and that's exactly how they do it. So they buy the paper in the West and deliver it in China. And so you end up exchanging for physical, making a huge arbitrage. But and they keep doing it to do that sucking sound you hear in the distance. That's them trying to entice. Yeah, keep giving it to us, please. We'll take it. We'll take it. We'll take it. That's what they're doing because they're using this huge trade imbalance that we've given them, the surplus of dollars, to buy up things like silver. So you keep that price higher and you entice those traders who can do it to deliver the metal there. That's exactly what they're doing.
This isn't speculation. It's mechanical arbitrage draining Western inventories. Andy Schectman has explained that when paper silver can be converted into immediate physical delivery, the futures price loses control. Turning a $10 per ounce premium into $200 million on 20 million ounces isn't theory. It's incentive. The Hong Kong COMEX delivery bridge removes shipping friction, accelerating outflows toward China. That sucking sound is liquidity leaving Western vaults, not price noise. Long-term investors should recognize this as a transfer of real assets, not a trade. His next insight shows why this pipeline strains the entire system.
Listen to what David Jensen says. He's the expert on the LBMA. He will tell you that there's 700 or 800 million ounces of silver in the LBMA, of which the majority belongs to the ETFs like SLV, storage programs like Bullion Vault that store it there. That's not for sale.
Right.
He will tell you they say there's a 140 million ounce float, which he disputes and says, I don't know if that's really free float. Difference between a float and a free float. The float meaning, or the free float meaning the bars standing behind the contracts. He will tell you there's 2 billion ounces of paper contracts outstanding against a 140 million ounce float. Now, what could possibly go wrong? And that's why they went to T plus 8 weeks for most of last year. What do you mean? It's a T plus 1 day settlement. Well, we don't have enough in the way of manpower and trucks, the Bank of England says. So you have to wait 8 weeks to get your bars. Really? That sounds to me like you got caught with your hands in the cookie jar.
Yeah.
And that's exactly what is happening.
When settlement stretches from 1 day to 8 weeks, confidence quietly dies. Andy Schectman often stresses that leverage becomes dangerous when paper claims overwhelm deliverable supply, and 2 billion ounces against a disputed 140 million ounce float proves the point. David Jensen's breakdown exposes how ETF-held metal isn't truly liquid, yet it props up massive derivatives exposure. T plus C8 isn't a logistics issue. It's a warning sign of strain inside the LBMA. For investors, delayed delivery is counterparty risk showing its face. His next warning explains why these delays may not stay contained.
Now, the part that I think most analysts have a hard time dealing with is the fact that we live in a world of instant gratification here in the United States. And you know, look at how fast things have moved in terms of, is it a new world? You know, I was talking about this and to someone else. My wife was next to me the other day. She said, but it's different now. You know, the world is different. No, it's not. Richard Russell used to tell me, who was one of the greatest human beings I've ever known in my life, that if you made 7% per year, you will go down in the investing Hall of Fame. But that changed with Apple and Nvidia and Bitcoin and this instant gratification of, you know, 5-fold increase in profit is something that is not sustainable in normal markets. And so I think that people have a hard time understanding that, well, why don't they just buy everything up? Because they would cut off their nose to spite their face and blow up the exchanges and everyone would figure out what they're doing. But if they cut you with a piece of paper over and over and over and over and over and over again, little cut, little bit, little bit, little bit, little bit, little bit, and now someone, thank God, has woken up in the West, here in the United States. Thank God someone got to this administration and said, we are being paper cut to death.
The most dangerous assumption in markets today is that speed equals progress. As Andy Schectman has emphasized, historical return expectations didn't disappear. They were distorted by a decade of liquidity-driven outliers like Apple, Nvidia, and Bitcoin. A 7% annual return still compounds wealth, yet investors conditioned by fivefold gains now dismiss discipline as obsolete. Gradual price suppression works precisely because it avoids panic, draining value quietly instead of triggering alarms. That paper cut strategy doesn't break systems overnight, but it hollowed them out over years. What comes next explains why patience, not hype, is becoming the real edge again.
If we do not do this and start becoming massive importers of this stuff, and we'll call it tariffs, it's not tariffs, it's reshoring. If we call it tariffs, they'll believe it, because these banks were all collusive together, the Western banks. What, in essence, Luongo is saying is that Trump flipped the script. He's very angry and believes it was the people, the European elite, the aristocrats, the old money that was behind all this, that did everything they did to keep him out of office. So we'll flip-flop. There's this massive short position that you guys have, you 5 Western U.S. banks. We're going to say it's tariffs. Don't worry, it's only one way. Well, the bars will come back, just we need to cover. No, we need to reshore. And now we go long. And what happens when there is a failure to deliver? And I've told this story over and over and over again about Bear Stearns and Bart Chilton and his interview on Chris Marcus's podcast and on Andrew Maguire's podcast, where he admits that Bear Stearns largely went bankrupt because silver went to $21. They had the largest short position. And what happened after that with JP Morgan. And the head of the CTFC admits this on these podcasts. No one talks about those things that are mainstream analysts. They just think we're crazy for saying things like this, yet they keep happening. And I keep getting proven right. I'm not saying I'm a soothsayer or anything. Maybe I'm just stupid enough to say these things in public. And when I'm wrong, I admit it.
Tariffs are the headline, but balance sheet survival is the motive underneath. Andy Schectman has warned that when banks are cornered by outsized shorts, policy narratives become convenient cover. Bear Stearns collapsing after silver hit $21 is not folklore. It's documented by former CFTC leadership in recorded interviews. Forced reshoring under the banner of trade policy masks a scramble to neutralize delivery risk. When failures to deliver surface, markets reprice brutally, not gradually. The next point shows why denial from mainstream analysts keeps repeating the same mistakes.
It's funny because Van Eck, which is the mutual fund company, they just came out and they said if the dollar loses reserve status, could gold surpass 39,000? This is by Van Eck. I'm just going to read one thing. It says, what if gold replaced the US dollar? Now, I would say, what if gold replaced the US Treasury, which I believe it is, as the reserve standard? And here they put the reserve. So the dollar, you go back to mercantilism. All these countries are using their own currencies, trading over networks that are not compatible with the SWIFT. We're seeing that all throughout the BRICS, right? It's already happening with the SIPs, the cross interbank payment system, and Enbridge, both operational now, trading local currencies and using gold instead of treasuries. But it says, what if gold replaced as a reserve standard? In this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves, implying a $39,000 to $184,000 per ounce price.
The radical part isn't the gold number, it's who's publishing it. Andy Schectman has noted that paradigm shifts matter only when institutional firms acknowledge them, and Van Eck doing so is significant. A $39,000 to $184,000 valuation range isn't speculation, is derived from matching central bank liabilities to existing gold reserves. BRICS payment systems already bypass SWIFT, proving this transition isn't theoretical. Investors ignoring reserve reconfiguration risk mispricing currency and bond exposure simultaneously. Next comes the math that explains why trust, not inflation, is the real driver here.
If using M0 money, which is the foundation of money, it's just the money that's immediately available in currency, for the entire monetary system globally, every dollar of credit, debt, and leverage is ultimately built on top of this, blah, blah, blah. We see gold at $39,000. If we use M2, liabilities divided by gold reserves, $184,000. That's Van Eck. That's not James Rickards or me or
Right.
Mike Maloney. Right? That's Van Eck.
How much was that M2 based one?
$184,000.
Oh my God.
M2 liabilities divided by gold reserves is 184,000 per ounce, weighted by daily FX turnover. Using global M2, where we have global series, unlike for M0, we calculate the global price of gold that equalizes M2 is around 100,000 per ounce, weighted by daily FX turnover. The gold price that equalizes M2 is 184,211. That's from Van Eck. So I'm just simply saying that these things have never found their price discovery in a world where it was all based on trust. The trust is gone. Our fiscal responsibility is thrown to the wind. And the world is looking for alternatives to a system that had been weaponized against other countries and wonder, is it us next?
This isn't fear. It's balance sheet arithmetic finally being acknowledged. Andy Schectman has argued that gold never needed to rise. Currencies just hadn't been marked honestly. Van Eck's M0 and M2 comparisons expose how much leverage rests on shrinking trust, not growth. When systems are weaponized, neutral settlement assets regain relevance fast. Investors should recognize this as a credibility crisis, not a commodity trade. The final insight shows how quietly this shift is already showing up in real prices.
And it would be very wise to not be reliant upon just that one entity that can make and break you based upon the way that they look at you. And so, I don't know. Yeah, I think you're going to see this accelerate in gold as well. Silver is where the real horsepower is. But let's just be honest. I don't really have anything that will illustrate its size, but a D battery that you could hold in the palm of your hands is a tube of gold eagles. It's $100,000 now, basically. When I started, even as recently as when I started doing shows with you, $100,000 in gold would have been closer to 50 ounces, maybe 45 ounces. Now it's closer to 20 ounces. It's accelerating quietly. And that's the thing is that, people.
That's a good way to say it, though. It's a little big, but I could basically conceal $100,000 in my hand with
right.
gold.
And that with silver, it used, when I started doing these with you, would have been probably about 1,500 ounces minimum, maybe even closer to 2,000 in silver. Now it's 1,000 ounces is $100,000. And so it's accelerating, and you don't get any media coverage of this. The public is being left out by design.
The shift is visible, but only if you measure value by weight, not headlines. Andy Schectman has highlighted how gold's quiet compression, fewer ounces representing the same dollar value, signals acceleration beneath the surface. $100,000 shrinking from 50 ounces to 20 isn't volatility, it's repricing. Silver's move from 2,000 ounces to 1,000 tots tells the same story with leverage attached. Media silence doesn't mean stability. It means redistribution is underway.